Hi everybody, welcome to another update on the gold forecaster index, the holy grail to predicting gold prices. In my last video, I said that gold is positively correlated with bond yields. So if gold goes up, then yields should also go up because it's a sign of inflation. So how has gold been doing since last month? Gold has gone up by 5.3%. And the bonds have gone down by 1%. So we were right once again. And this means that gold is indeed positively correlated with bond yields. Okay, so let's see how we're doing on this chart. Yep, gold is up. So let's look at our current data point for the gold forecast index, which is a leading index. As you can see here, it leads the gold price. Now the latest data point is pointing up for September, but we are still not above zero. So I still expect gold to be weak going forward, but it's improving. So we need to have some patience, wait until this chart, this red line goes above zero. And we are getting there at some point. Maybe next year. But the trend is positive. It's going up. Taylor roll rate, well, it is going down, so that's not good for gold. But at the latest data point here is pointing to a bottom. So this might be a bottom for gold if this starts to turn up again. Misery index is also bottoming out. We have higher unemployment and inflation is also going up. So this is positive for gold. However, real output is actually increasing, so that's negative for gold because productivity will lead to less inflation. And we do not want productivity if we want to have gold going higher. So the world is still productive, which will put a lid on the gold price. This is interesting. We have a massive gap between the gold price and tons in the GLD trust. At some point, the tons in the GLD will need to go back up, and that's when gold will break out. So watch for this orange line to bottom out. Same with COMEX. You can see that gold is leaving the West and it's going to China. So at some point, this needs to stop, and that's when gold will break out. Same with LBMA. Gold is leaving the West and is going to the East until it isn't anymore. When it bottoms out, then gold will start to rise. Latest gold demand data from China, pretty flat. So yeah, gold will probably be flat going forward. At least it's not crashing. Silver demand is pretty weak. So nothing special to see here. SLV ounces are still going down. PSLV is also going down. So there's not a lot of interest in silver. And silver is still at 22, so not a lot of interest. Demand for silver in China is also going down. Not looking good for the silver miners. COMEX silver also going down. Not good. On the US mint sales front, however, we see some interest coming back, higher sales. But when we look at the silver premiums, I have warned about this. The premiums are down. So that means that there will be weakness in the silver price. Every time when you have low premiums, it coincides with a top in silver. Right? You can see this everywhere. It's always a top. So this is probably also a top. I would be very fearful about buying silver. Same here, junk silver, very low premiums. Typically, this is a top, and we should go to $20 silver. Yeah, it is what it is. I can't help you with that. I'm just presenting the data. However, for gold is still at 2% premiums in China. So this should break out. And I think that gold will break out by next year. Mid next year, we will see new all-time highs as the premiums go back to zero. Actually, the silver premiums don't look that bad in China. Pretty high, so there may be some hope for silver. Upmix and gold premiums are somewhere here at 5%, still higher than historical data. PSLV premiums are still negative. COT report, we are in neutral territory now. So it could go up, it could go down. Today it's going down. So pretty neutral. We do see some open interest increases. So that could lead to a bull market, but this needs to rise more than that. Lease rates are actually not that bad. So up, up, and now we are in a down cycle again. So there should be some support for higher gold. For silver, less because this chart is already down. So silver will be weaker than gold. That's what I think. So I would stay with the gold miners instead of the silver miners. Swiss franc is up, that's good. Here I'm hoping that the tips will move up again and then we will break out in gold. Real yields are still positive. We need to see this go negative again. Maybe when we get rate cuts next year. Seasonality is very good. We are now in November. So this should be a bottom and we will go up until March next year. Gold miner sentiment is very low, but I think we are at the bottom and it should go higher. Currency in circulation is not rising anymore. That's a problem, but gold looks very cheap here. Stocks are overvalued. So we are going to stay with gold. 30-year to 10-year ratio is actually moving higher. That's very positive for gold. Okay, this looks like gold is going to break out. Google Trends. on how to buy gold is actually flat, but it's higher than historical numbers. Debt to GDP, we know that debt is still rising, so that's good for gold. Near-term forward spread, we want this to be negative. Because that means that interest rates are going to go down. And yes, we are still at minus 0.6. So we stay in gold until this chart goes to, let's say, 0.5, and then we will sell our gold. But we're not there yet. Rate cuts are coming. I'm pretty sure about that because a recession is coming. And when a recession comes, the Fed will cut rates. And you can already see here the 2-year yield is going down very fast, actually. So prepare for rate cuts. It is coming at some point. So now we are topping out on the 2-year. Then the Fed will pause and then cut rates. So we will probably see a pause for a few months and then rate cuts, which is very bullish for gold. As you can see here, rate cuts are good for gold. Foreign deposits, foreign gold deposits are still rising. This is a new trend. Normally it goes down. Now it is starting to rise. So central banks are buying gold. The bank term funding program is still increasing. So there's still stress in the banking system. That's good for gold. So overall, it looks very good. We stay in the gold space. Try to buy gold miners with high margin because gold is not going to soar. It's going to grind upwards at a very slow pace. So it's best to buy gold miners that are actually profitable right now. Here you see that the economy is not doing well. It's negative, not good for copper. Yeah. I have reduced my position in copper. I'm not that bullish anymore. And that's because of this. So the inventory level was supposed to go down, but look at this, it's rising again. And here it's going down, but less than the historical number of last year. So I mean, it's not really bad. Inventory numbers are still very low for copper, but it's not like it's super bullish. I think copper is fair value at 3.7. So here you can see Goldman Sachs said that we should be at 0 right now. We are not at 0. We are now somewhere here. So a complete miss by Goldman Sachs. Yeah, social inventories on copper are still very low. So you have that going. It's not like we have a lot of inventory in copper. Still at all-time lows. China power consumption still rising. That's good for commodities. Credit impulse, however, is not good, below 0. So I don't see copper soaring at all. It's going to be flat to down. Shanghai Composite Index. We were watching if this is going to break up or down. And there's this triangle pattern. And we still don't know if it's going to break up or down. It's just staying here at this tip here, and something big is going to happen. We just don't know which direction yet. Is it going to go to 2000 or to 4000? Stay tuned. GDP forecasts has gone down. It's now at, actually it's back up. It was at 1 and now it's back to 2%. Interesting. Here as well, the refined to scrap copper premium is at 0 right now. This is an old chart. Currently we are at 0, so copper is actually neutral at 3.7. Yeah, so I don't see a lot of upside in base metals. Inflation is still rising, so that's good for gold. Other than that, yeah, the Hong Kong housing market is crashing. That's bad for copper. Also, the China airplane data is weak, so that's bad for oil. So I think gold is the only place that we can stay in right now. Let's take a quick look at the bonds. Bonds were pretty strong lately, but I think this is just temporary. I don't see bond yields coming down that much unless we get a real recession maybe. But you can see here, for example, foreigners are selling US treasuries. So the percentage of foreigners holding US treasuries is going down. Same year for coupons, tips also down. So there's not a lot of appetite for bonds. You can see that here, down. And this is a very important chart. The bond value is the sum of the money printing plus the budget deficits. So high budget deficits, that's the orange chart. High budget deficits means that bond yields go up because you are issuing more bonds. So that means that yields will go up. And money printing is also correlated to the bond yield. The higher the money printing is, the lower the yields, because if the Fed buys those bonds by money printing, then the yields will go down. So that's the blue chart. And you can see that it's below 0. So below 0 means no bond buying, only bond selling. So yields go up. And you can see here in green that the yields are going up. This is a minus sign. So green going down means yields going up. Okay. So what is Powell currently doing? He's not money printing. He is doing QT. So bond value is going down. Budget deficits, look at this. This is how the budget deficits will evolve. Projections from October are higher than usual. So I think budget deficits are going to keep soaring in the future from 2024 to 2033. And as you know, higher budget deficits will lead to higher bond yields. So please don't buy bonds. Do not do it. Only buy gold. And actually, bonds are very bad value anyway. As you can see here, bonds are still overvalued. Okay, so this means overvalued bonds, here undervalued bonds. So we are still not above the zero line yet. Okay, so, and here you can see how many bonds will be issued. 2.5 trillion per year. Okay, a lot of bonds coming on the market. And long term, I think this this trend down is going to revert back up. Let's say to 6-8% at least. Okay, so these are the deficits. We had deficit numbers. Let's see. Goods deficits increased, and even the services surplus has gone down. So both items are going negative. Not good. This trend is also going down. The blue line's going down. That means that the trade balance is probably going to go negative again. So not looking great for the USA. Import-export prices. Import prices up, export prices down. So higher deficits. Here, now this is for commodities. Prices up means inflation. And what's this? This is still old data. But I think that the trade deficit's going up. That's the red line. Means that the dollar will at some point roll over. We're not seeing it yet, but I think it's about to roll over. At least next year it will start to come down. Central bank balance sheets are still dropping, so that means yields go up. So central banks are not buying bonds anymore. Why should you buy bonds? Nobody is buying bonds. Even the central banks aren't buying it. They're buying gold. So do what the central banks do, buy gold and sell bonds. Look at the Federal Reserve. They are selling treasuries and selling mortgages. So you shouldn't buy them. You should do what the central bank is doing, and that's buying gold. This is interesting. The repo is the blue line. When this hits zero, then problems will start to come. So now we still have some liquidity, but if this goes to somewhere here, then watch out. Money supply is coming down. Not so good for gold and stocks, but okay, we have a huge rise anyway. So we still have inflation in the system. What is the Fed going to do? Yeah, the Fed is going to cut rates. That's obvious. Next year we will see rate cuts. And based on the 2-year yields, it's going to go fast. As you can see here, it's down a lot. So rate cuts will come. Not sure when. Capacity utilization was pretty okay at 80%. So there's still inflation in the system. Let's talk a bit about oil. Yeah, this is the European diesel demand. It looks like it's going down. I have sold my oil positions. I'm not happy with how oil is going and how the demand is going down. It's already below $80 per barrel, so no, it's not working out. I will stay in gold miners. And this is also a very interesting chart. So we have the metals to gold ratio or copper to gold ratio, and this is going down. So gold outperforms copper here. But on the other hand, you have the 10-year yield going up. So who is right here? And I wouldn't say that bonds are wrong, because that would mean that the 10-year yield should go back down. And I don't think that bond yields will go down that much, back to 2%. So then you would say that this green line should go up, right? But that would also be against my prediction, because that would mean that copper would go up and gold would go down. And that's also not what I think will happen. So I'm a bit stuck here. I don't know what is happening here. I think yields should be going up. Yes, it should be going up. But the green line should also be going up. But it isn't, because gold is massively outperforming this time. And that's because central banks are buying gold. So normally it should be going up with gold going down. But now it's dropping with gold going up because central banks are buying gold. So that's what I think is happening. Will it revert back? Will the gap close? I don't know. It could be that this is a new point in time, that this here is all past, and that we just need to make this our 0 point again and remove the gap. I'm not sure. COT report, this was a very nice chart. You can see here that the average of the net gold swaps is actually, yeah, it's neutral, but the gold price, when you intersect here, it's actually moving up. So this means that gold is in a rising trend. And if you extrapolate this, you will go to 2,200 in about 1 year. Yeah, in about 1 year, we will head to 2,200 gold. That's up 10%. Not bad, 10%. If you can leverage it up with a gold miner, then you get maybe 50%. So that's a very good return. But the conclusion is that gold is in a rising trend, okay, based on the COT report. Last chart. Where are we in the cycle? As you can see here, commodities are very cheap. We should be moving higher. And when you look at this chart here, then you can see the bond returns and the stock returns. So when both bonds and stocks are returning negative, then you are in this quadrant. 2022, 1931, 1970. Now look at this, 1930, 1970, and 2022. So we are currently in an era where bonds and stocks both will underperform. And the only thing that will perform is commodities. So these are the points where you should be in commodities. And that's where we will stay. We stay in gold, maybe a bit of copper, and that's it. We stay out of the stock market and the bond market. So that was the update. It's still looking good for gold to go higher. And we are going to keep holding our gold miners as the trend is moving higher. And I'll see you in the next video.